Robots will take over the world. Have you ever thought about building an amazing robot company? Killer robots! No, robots that will helpfully change the world. Do you want to be Iron Man? In this How to CEO, I'm delighted to be interviewing the founder of Knightscope. He's raised tens of millions of dollars through non-traditional means to build an amazing robot company. Bill, welcome to the show.
Absolutely. Thanks for having us, Murray. My name is Bill Lee. I'm the CEO of Knightscope. We build these crazy set of autonomous security robots that are patrolling across the nation. Today, from Alaska to Rhode Island, we're fully autonomous 24/7 across 5 time zones. When we started the company back in 2013, I was told the following: "Hey, Bill, you're out of your mind. This will never work. It's hardware and software. Too complicated. You should pick one. And third, physical security is not an investment thesis, and you need to go away." And that was all kind of the wrong advice and wrong answers. And so what you get from a bunch of relentless entrepreneurs is they're going to prove everybody wrong.
Right.
So now we've raised over, let's see, probably over $70 million to date. We are backed by over 19,000 private investors, family offices, accelerators, and 4 major corporations. Got about $10 million of lifetime revenue, and we've operated over 1 million hours out in the field. So for any founders on the call here, just don't let anyone ever tell you no. You just got to kind of keep pushing forward.
So focusing on that core thesis,
Yeah.
how do you know which type of capital to go after, and how do you get that fit, and why do you think so many people get it wrong?
Okay, this is probably something that most financiers don't really want to share with founders. And as I mentioned to you, Murray, one of the reasons I'm willing to do this a little discussion is I get pinged every 24 hours from some founder or entrepreneur needs some help, and I'm running 100-hour weeks, and I just don't have the bandwidth, and I feel awful that I can't provide more than just here's a blog that I wrote some time ago. So let's get into it. A lot of founders are told you must focus on product market fit, product market fit, product market fit. That's it. And when you get that, come back and see me, right?
Right.
Rarely or never is a founder told you kind of really need to think about capital to company fit. What is it that you're trying to accomplish? What are your obligations? And then what's the type of capital that you need? $100 billion, at least I think this year is $130 billion goes into startups every year. Crudely speaking, I'll probably be off by a little bit here, but 85% goes into software related companies. 10-ish%, I think, goes into biotech, and then 5% goes into other. Right. And then a small sliver of that maybe goes into robotics or hardware or something else. And most of the funds, there's a handful of folks that I have massive respect for, but most of the funds, their business model is to be wrong 9 times out of 10, which is fine, but don't walk around with an attitude that you're right 9 times out of 10. And let's do a positive example. So let's say you're doing a social media app, and Mark Zuckerberg retires, has a fund of 6 former Facebook executives, and they're going to coach you and counsel you and all this stuff on how to build your social media app. Like, they give you a term sheet, just sign it, right? Give them the board seat, just move on, because they can actually be genuinely value add. In a lot of cases, that's not the case, where a VC won't have sector expertise, worried about all the wrong questions, asking all the wrong questions, worried about all the wrong things. And you, as an officer of the company, you actually have a fiduciary responsibility to your shareholders, be it your friends and family, be it the seed round you did or the Series A, and your teammates and your clients. So you, in the public markets, let's say someone buys 5% of your shares. Emergency board meeting, call the crisis communication people. We have an activist single shareholder, which you can figure out the acronym there, and you've got a problem, right? That's not a good thing. Here in the Valley, Someone buys 20% of your company in a round, steals 2 board seats, and the CEO sends out a celebratory press release. Did you really think this through? Did you do your homework as a founder and do your basically your fiduciary responsibility to assess all the places where you can raise the capital and get the right capital for what you're trying to do, right? And I think that little step is missed because most founders don't want to understand that, you know, VC money, and my team hates me for saying this, VC money in a lot of cases is dumb money.
Okay.
But most folks don't want to say that in public. In some cases, it can be absolutely brilliant money, right?
Right.
But you got to think through what kind of company you're trying to build and what type of shareholder base do you want long term? What kind of help do you need? What weaknesses do you have? What strengths can you capitalize on? And the federal government changed the rules on how you raise capital back in 2012. The SEC got around to finally enacting it in the 2015-16 timeframe. And now, basically, a private company can do a public offering and remain private.
Yeah.
Let me repeat that. A private company can do a public offering and remain private, all right? And we can dig, deeper, Murray, if you'd like, but, my one bit of advice for founders is, before you start raising capital, like really think about who you need on your extended team to help you out. You might just need silent capital. Like you're not 26 years old. I don't need adult supervision. I kind of know what I'm doing. I just need the money to get going. That's a different type of capital need than someone just got their MBA. They finished a year at, I don't know, at Tesla or whoever, and want to go strike that out on their own. And they don't know anything about liquidation preferences, governance, how to scale a business or anything else, and genuinely need like hands-on help. You got to kind of think through the whole thing.
I mean, I have spoken to a lot of founders who say even later on, even more experienced founders say getting the right investors who have maybe access to channel, access to partners, access to market has been incredibly successful. And you are, as far as I'm aware, the most successful crowdfunded company so far.
Murray, I hate that term crowdfunding. It drives me crazy.
Okay.
But what do you think Morgan Stanley and Goldman Sachs do all day long?
Right.
When someone files an S1 for an initial public offering for an IPO, Goldman and Morgan run around and do what? Get every Tom, Dick, and Harry to buy shares all around the world.
Yep.
Sounds like crowdfunding to me, no?
You're saying it's the same. Okay.
You got to get all these crazy people on your cap table are going to drive you crazy. And I get institutional investors asking me like, hey, Bill, you've got 19,000 investors. Like they must be driving you crazy. I'm like, well, yeah, there's a few emails here and there and some messages. It's usually, how do I write another check? Can I introduce you to this potential recruit? I have a potential client here. Do you need some new bankers that you need to work through? I mean, how folks can be so profoundly helpful is, I would never trade 19,000 investors out that we have for 4 institutional guys from down the street who no sector expertise in physical security, law enforcement, robotics, or hardware, and with a track record in any of those categories. But that's for us, right? Our mission is to see if we can make the United States of America the safest country in the world. I'm not going to be able to do that with a handful of investors and we're going to go change the world with just capital, right? You're going to have to run this a little bit like a political campaign to get society to change on the tools that we provide our law enforcement professionals and security guards. But that was a decidedly, kind of different approach, kind of strategic long-term. And now things get really interesting because if you start looking at, I don't know, if we were thinking about a SPAC transaction, right? If you're familiar with that, right? You get the SPAC has some capital in trust, and then they want to put a pipe on top of it. Well, then now things get really interesting because we bring to the table 19,000 retail investors that can give you that volume that in a lot of cases, if a company goes public, they've got, I don't know, 10 investors.
Yeah.
And they literally hire banks to go here's 25% of the book, go get me some retail, right? So again, it's not for everyone. All I'm asking is folks need to think about who you need and what type of capital, and then figure out how to go about, going down that path. In some cases, VCs can be profoundly helpful. You get the 2, 3 right folks, and maybe it's not the firm, it's the actual partner, similar to an ad agency or PR firm. And they can move mountains for you if you've got the right kind of match. And their business model is to be wrong 9 times out of 10, so you can figure out how many times that match actually occurs.
And you've been very successful at this. Who've been the best partners for you along the way in raising that capital in the way that you have? And who would you recommend people to go to?
I'll tell you a quick story and then I'll answer the question. So, back when we were raising the initial round, I think the seed round might have been like a $25,000 minimum at the time. And there was one investor who was pleading with us, like, please, I only have 10 grand to put into this deal. Let me in the deal. I don't know why I decided, okay, fine, let's just do it and get it over with, not thinking it all the way through. A few years later, he raises his own fund. He's probably now invested in a couple of 100 companies. He introduced us to one of his limited partners in his fund, who subsequently wrote a very large 7-figure check into the company. In some cases, it's not the amount, it's the person, it's the connection. The world works around what? People, cash, and relationships.
Yes.
And in a lot of cases, that can be really important. Go do your homework. Go look up Regulation CF, which the SEC is just making some big changes. The cap used to be $1 million. I think by second quarter, it should be 5 million that you can do in a raise. A Regulation A+ for larger rounds. The limit was 50 million. I think by second quarter should go up to $75 million. And there's several broker dealers out there to do this in a regulatory compliant manner. And back in 2017, the team at Seed Invest did very well for us. I think we raised $26 million or something to that effect. For lots of reasons, we ended up switching over to Start Engine.
Yes.
And this last year we raised, I think it was 28 million in that. So, and there's others, but do your homework on Regulation CF and Regulation A+. And one other bit of advice: if you're going to go down this path and you think it makes a lot of sense for you, and it's not for everyone, there are kind of 2 things to think about. One, please don't think that you're going to turn on a website and then money is just you're going to download cash from the cloud and it's just going to show up in your account. You need to put in the work.
Yes.
And what folks don't realize is, when things are being done private behind closed doors, it's the same amount of work. Raising a round can be 3, 6, 9, 12, 15 months. In this particular case, you're doing it publicly so everyone knows how kind of you're doing.
Yes.
So there's a lot of effort. You got to put in, it's a different kind of work, but it's the same amount of work.
Yes.
So you're going to kind of think all that through. I think the other point is it can be a very healthy stepping stone to being one day a publicly traded company.
Right.
So because of the manner we raise capital, we report to the SEC, the United States Securities and Exchange Commission, every 6 months, as if we're publicly traded, but the stock is not yet on an exchange.
Yes.
Said a different way, we have all the hell of being a publicly traded company without any of the benefits. So I got to get us out of this purgatory at some point in time. But for those companies or founders or folks familiar with private equity or VCs, and that's that step where it's a big culture shock of, what do you mean we have audits every year? What do you mean we need better governance and controls and all that other stuff? Having to do this kind of approach with the SEC, it's a half to 2/3 of the work. So it's kind of a nice baby step. So you don't get a big shock when you're actually publicly traded in time for that earnings call or that quarterly filing, because you've built out the team, you've got the processes, you got the fixing any whatever audit issues might have or material weaknesses. And it can be a very helpful thing. It's painful. Don't get me wrong. It's not fun, but it might be better for some companies not to do the on-off switch. Like, hey, you're private. Nope, you're public. Like that can be dramatically painful.
A lot of work, yeah, I imagine. Thank you so much. Some wonderful advice. Thank you for being on the show, and I look forward to.
I'm going to get in
speaking to you next
trouble for what some of the stuff I said, Murray. It's going to be on you.
time. You said it. So thank you so much.
Absolutely. You'd be
I'm
good.
Murray Newlands. You've been listening to the How to CEO podcast. I'll see you next time.